Welcome to our 401k allocation showdown. In this video, we will simplify one of the most important choices in your retirement plan, whether to use a target date fund or build your own low-cost 3-fund index portfolio. Rather than chasing hot stocks or complex products, we will focus on the smart money approach of broad, low-fee index funds. We will compare simplicity versus control, explain rebalancing and glide paths, and walk through clear steps for both strategies. By the end, you will know which approach fits your time, interest, and risk tolerance. Let's begin by previewing our agenda, and then we will dive into why your allocation decision matters so much for your future. Here is today's roadmap. First, we will clarify why your allocation decision matters. Next, we will compare target date funds and the 3-fund index portfolio. Then, we will use a decision flow to help you choose, review typical costs and common pitfalls, and finally walk through step-by-step instructions for both strategies. Along the way, you will get a quick Markdown cheat sheet and short quizzes to reinforce what you learn. Now, let's move into why allocation matters. To start, asset allocation is the main engine of long-term investing results. The exact stocks you pick matter far less than how much you allocate to stocks versus bonds, how diversified you are across the globe, and how consistently you stick to your plan through market ups and downs. Low costs are crucial because fees compound against you, just like returns compound for you. Meanwhile, having a disciplined process, whether automated or manual, helps you avoid emotional decisions during volatility. With that groundwork, let's transition to the first option, the simple, automated path that many investors choose: target date funds. Before we proceed, please note this is educational content and not personalized financial, legal, or tax advice. Everyone's situation is different, and employer plan menus and fees vary. You should consult a qualified professional and review your plan's documents before making investment decisions. With that in mind, let's explore the first strategy in detail. Target date funds, or TDFs, are all-in-one solutions designed around your expected retirement year. They hold a diversified mix of U.S. and international stocks plus bonds, and automatically rebalance for you. Over time, they follow a glide path that reduces stock exposure and increases bond exposure as you approach retirement, making the portfolio more conservative. The appeal is obvious. They are simple, hands-off, and help prevent emotional trading. However, the trade-off is that these funds are standardized. They may not match your personal risk tolerance or goals perfectly. Additionally, although many TDFs are competitively priced, some plans include higher cost options, so it pays to compare expense ratios. As we transition, let's examine the higher control alternative: building your own 3-fund index portfolio. The 3-fund index portfolio gives you complete control by combining total U.S. stock, total international stock, and total bond market funds. You decide your exact stock-to-bond split and the U.S. to international mix. This approach can be extremely low cost if your plan offers broad index funds with low expense ratios. However, it requires you to set and maintain your allocation, monitor it periodically, and rebalance when it drifts beyond your chosen thresholds or on a set schedule. This manual rebalancing is not complicated, but it does require consistency and comfort with occasionally selling winners and buying laggards. Next, to help you choose between these paths, let's visualize a decision flow. Now let's walk through the decision flow. We begin with an investor profile and consider 3 factors: the time you have available to manage your portfolio, your interest in learning about asset allocation, and your comfort with rebalancing tasks. If you have low time, low interest, and low comfort rebalancing, the flow points to a target date fund as the most suitable option. Conversely, if you have high interest, sufficient time, and are comfortable rebalancing, the 3-fund approach becomes the preferred choice. There is also a reminder note emphasizing that, regardless of path, keeping expense ratios low is essential. With the decision framework in mind, let's examine how allocations evolve over time with a glide path timeline. In this timeline diagram, we illustrate how a typical target date fund reduces risk as you age. At the early career stage, around age 25, the allocation is often about 90% stocks and 10% bonds to prioritize growth. By mid-career, that might shift toward a more balanced profile, like 70% stocks and 30% bonds. Approaching retirement, the mix may be near 60-40, and by the retirement date, some funds target approximately 40% stocks and 60% bonds for greater stability. This glide path is automated within TDFs. Next, for comparison, let's visualize a sample allocation slice that a do-it-yourself investor might set. This pie chart presents an illustrative aggressive allocation commonly used by younger investors. 60% U.S. stocks, 30% international stocks, and 10% bonds. It mirrors the growth orientation of early career glide paths while preserving some bond exposure for ballast. Your actual split should align with your risk tolerance and plan options. Now that we have looked at structure and visuals, let's directly compare target date funds with the 3-fund portfolio. Here is a direct comparison. Target date funds are the easiest to implement, with automatic rebalancing and glide paths that reduce risk over time. They are behaviorally friendly because they minimize decision fatigue. However, they can have higher expense ratios than a do-it-yourself index approach in certain plans, and customization is limited. On the other hand, the 3-fund portfolio grants full control over your asset allocation and can be extremely low cost. The trade-off is the need to manually rebalance and maintain the strategy with discipline. If you want set-and-forget simplicity, a TDF fits well. If you want control and are willing to do occasional maintenance, the 3-fund approach is powerful. Next, let's talk about typical costs and how to evaluate them. This table shows illustrative expense ratio ranges. Actual costs vary by provider, share class, and your employer's plan. Index-based target date funds can be quite competitive, but in some plans, a do-it-yourself mix of total market index funds may be cheaper. Always verify the specific expense ratios in your plan's fund lineup and prefer broadly diversified, low-cost options. Avoid specialized sector funds for long-term core holdings, since they concentrate risk and often cost more. With costs in mind, let's move to the practical steps for each strategy. Here are the steps for using a target date fund. First, estimate your expected retirement year and pick the matching TDF series. Second, confirm the fund is index-based and check the expense ratio to ensure it is low relative to alternatives in your plan. Third, review the fund's glide path to make sure the trajectory from aggressive to conservative aligns with your comfort level. Fourth, enroll and direct your contributions into the TDF. Fifth, automate contributions and let the fund handle rebalancing. Finally, revisit the choice during major life changes or if your plan's lineup updates, but otherwise avoid tinkering. Next, let's outline the process for building a 3-fund portfolio. To build a 3-fund portfolio, start by identifying the total U.S. stock, total international stock, and total bond market funds available in your plan. Next, decide on a stock-to-bond mix consistent with your risk tolerance and time horizon. Then, determine how to split the stock portion between U.S. and international. Set your contributions to approximate these weights automatically. Choose a rebalancing rule, such as an annual date, or a threshold approach like 5% bands. When rebalancing, sell assets that have grown above target and buy those that lag to restore your allocation. Review fees and fund options annually, but otherwise remain disciplined and avoid frequent changes. Now, for quick reference, let's look at a brief Markdown cheat sheet you can screenshot. This simple Markdown cheat sheet summarizes a common aggressive allocation and a straightforward rebalancing rule. You can adopt an annual date like your birthday for simplicity, or use threshold bands to trigger rebalancing when allocations drift. The avoid section reminds you to keep your core holdings broad and low cost. With the essentials covered, let's test your understanding with a quick quiz. Question: who handles rebalancing in a target date fund versus a 3-fund portfolio? Options: A, TDF, U, 3-fund, the fund. B, TDF, the fund, 3-fund, U. C, both are always fully automated. D, neither ever needs rebalancing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is TDF, the fund, 3-fund, U. Target date funds automatically rebalance and follow a preset glide path. With a do-it-yourself 3-fund portfolio, you are responsible for rebalancing according to your chosen schedule or thresholds. Now let's continue with another quick question about what matters most when selecting funds. Question: when picking funds in your 401k for long-term growth, what should you prioritize? Options: A, lowest expense ratios and broad market exposure. Sector funds like real estate or materials. C, money market funds for higher long-term returns. D, frequent trading to capture short-term moves. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lowest expense ratios and broad market exposure. Prioritizing low fees and broad diversification helps you keep more of your returns and reduces concentration risk. Sector funds and frequent trading typically add risk and cost without reliably improving long-term outcomes. And money market funds are not designed for long-term growth. Next, let's recap the most important takeaways. Here are the key takeaways. First, asset allocation is the primary driver of results. Second, target date funds offer automated rebalancing and a de-risking glide path. Third, the three-fund approach offers maximum control and can minimize costs if your plan menu is favorable. Fourth, always compare expense ratios and avoid concentrated sector bets for your core holdings. Finally, consistency and discipline are more important than complexity. With that summary, let's wrap up with next steps. As we conclude, decide whether you value simplicity or control more. If you are new to investing or prefer a hands-off approach, choose a target date fund that matches your retirement year and has a low expense ratio. If you are engaged and disciplined, set up a three-fund portfolio with a clear allocation and rebalancing rule. Automate contributions, review annually, and keep fees low. Finally, maintain diversification and stay the course. One last thing before we go. Thanks for watching. If this video helped you, please like, share, and subscribe. In the comments, let us know whether you prefer a target date fund or a three-fund portfolio and why. Your experiences help others learn. See you in the next video.